Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to hedge funds, portfolio managers, family offices, and high net worth individuals. We're very excited today to be joined by Siddharth Singhai, who is the Chief Investment Officer of IronHold Capital. We've done all kinds of interesting programming with them in the past. And Siddharth, we're very excited to have you. Thanks for joining us.
Well, absolute pleasure to be here. Thank you for inviting me.
My pleasure. So just as a starting point, can you tell us a little bit about how you decided to start IronHold Capital, what your investment mandate is, and what you guys are doing that's maybe a little bit different from the thousands of other hedge funds out there?
I've been investing in real estate for a long time, and a unique thing happened in real estate, and this was back in India, where property rates would double essentially the moment you had some other the maps were approved for a society, or some obstacle was cleared, or if you could figure out in advance if the society would be cut in this manner, and that would allow this strip to be close to the main road, and so that would make it commercial. So all of those things were essentially inefficiencies in real estate that I was exploring them every day. And the way we made investments, it was really value investing as applied to real estate. But I just didn't know that at the time. And then I stumbled upon Mr. Peter Lynch, and obviously he wrote 2 fantastic books on value investing. And that phenomena, when it was laid down in readable form, that really made me addicted to the equity side of value investing. And so that's how I got started in value investing. And I've been doing this for like almost a decade now. And so I thought, well, I've been managing money for friends and family, and had decent success with that. So I think it's time to, pursue this as a full-time career, as a profession. And I think the hedge fund vehicle is the best way to go about that. So that's sort of how, I transitioned into starting a hedge fund. What we do, obviously, is at IronHold Capital is different than other hedge funds in the sense that most hedge funds in the US have a US only mandate, or they just cannot invest internationally, or if they have to, they need, all kinds of ears on the ground. And they don't have that. They do not have the knowledge of the culture, the democracy, the economy, and just the politics that's involved in investing in a foreign country like India. So, but the problem with all of that is you're missing out on a lot of opportunities, right? If you just invest in the US, you're competing in a market where you have 15,000 or so actively managed funds, hedge funds and mutual funds, all looking at 3,700 or so listed equities. It makes the job of finding inefficiencies, if you're a value investor, or just finding asymmetric bets in the market, very difficult, because it's sort of like fishing in a lake with 1,000 other fishermen, all fishing for the same opportunities. And it's not only that, but also, US economy has matured over the years, and while it's a fantastic market, I wouldn't expect real GDP growth to be more than 2-3% moving forward, as the population growth matures over time. So not only are you fishing in a lake with too many other fishermen, the fishes are also not of the highest return variety. So when we look at India, on the flip side, it's got 5,000 listed equities and only 500 actively managed funds looking at those equities. In addition, it's also growing at twice the rate of the US GDP. And so fishes are plenty, fishermen are few, and there are also the higher return varieties. So I think our edge comes from being in a market that's, in my view, resembles much of the US's market in 60s and 70s, when Mr. Buffett would sit down with Moody manuals and flip through those manuals. Information was not available easily to find opportunities. And I think just the quality of opportunities that you can find in India far exceeds, other developed markets. So us being there in itself is an edge. And then obviously, I was born and raised there, so I understand the nuances of the economy and all those other things that I mentioned. So I think that's really our edge. We are in my view, a superior market.
At any given time, how much of your portfolio is invested in the US, how much in India, and how much in other countries?
So it's about 60-40, with 60 weighted towards India, typically. It changes, obviously, because like right now, the US market is really expensive. So we're not finding very many investments here compared to the Indian market. So it's slightly weighted more towards India than it would normally be. But we try and keep it around 60-40. And we don't really invest in other countries. Maybe indirectly, if they're listed here on the New York Stock Exchange or maybe in the Indian exchange. But we won't be trading on, let's say, the Chinese exchange or Japanese exchange.
Got it. Okay. So how did you gain a competitive advantage in India? Obviously, you mentioned before you grew up there. It's a country that you understanding the politics, the business environment, the economy there certainly is a big help, but you're not the only one who was born in India who would understand that. How do you use your skills as a value investor to get an edge over the other people who have comparable knowledge of the Indian market?
Well, so I think the key feature in the Indian market is that it's not as sophisticated. Like in the US, value investing is pretty well known, and got a number of value-based hedge funds alone, not counting the growth at reasonable price and all those. In India, since the markets are not as mature, there's not enough competition there. Most investors in India are short-term investors, which is they really are speculators more than they are investors. So the edge you get is from the time arbitrage. Even if you have a 2-3 year time investment horizon, that in itself is an edge over the speculators, because they give you many opportunities, and if you could just be invested for the long term, you'll be able to utilize that. So it's really no different than how value investors get an edge here in the US market. And then obviously value investing is equity, because if you're going up against a mutual fund where the mutual fund manager has a number of restrictions on him, depending on size, depending on his pressure to really keep up with the market, or at least not underperform when the market outperforms, he's really restricted, the average mutual fund manager, in what he can do. And if you are not as restricted, we're not obviously as big, so that affords us a lot of opportunities that they don't have. And it's the same case in India. The Indian mutual fund managers have very many restrictions regarding size, and that sort of forces them to miss out on a lot of opportunities that we can lap up. So I think time arbitrage and just the size both serve as a big advantage.
Any sense on why the Indian market may be more characterized by speculators versus medium to longer term investors? What's different about it?
Well, I think So I should say is financial sophistication. Um, Investing in equities is really a new thing for Indians, I would say. It's really taken off in the last 15 years. And though the equity markets have been around for almost 50 years now, information wasn't easily available. You had to call up brokers and all of those things. Now we're at a point where all of that's accessible to the average person. And however, what they don't have is the financial literacy um, about these instruments because there's no history. It's not something you can find in any educational courses at school or colleges. And because it wasn't really popular for this long a time, people don't know how to deal with the markets essentially. Whereas in the US, though there is speculation and it's really pretty insane right now, but on average, people have seen their parents invest in the market and they've seen their parents invest in the market. And so they see the long-term effects of investing. So they're more likely to stick with investing. So India will become a more efficient market moving forward as people realize the benefits of long-term compound. So I think that is the key factor as to why you have more speculation there.
I think that makes a lot of sense. I mean, certainly, if anything, the mutual fund business has done a great job in saying to people you should own long term. They've marketed very well and told people just own everything long term, never sell, buy the dip. They've marketed very well at keeping people invested over long periods of time. Certainly, Peter Lynch, you mentioned, was one of those people. I read his books when I was in college. They definitely stuck with me. It was maybe the best introduction to value investing I've ever seen as well.
Yep, absolutely. Those were some fantastic books.
What about the regulatory environment in India? I know, and I'm not current on this, but I know years ago, insider trading used to be legal there. There were ways to get what Americans or the US markets would consider to be an unfair advantage. Where do things stand now? How's the regulatory environment and the Indian version of the SEC compare to what we have here?
Sure. So Indian version of the SEC is SEBI, which is Securities and Exchange Board of India. And really over the last 15 years, they've wised up and really built up layers of regulation that protect general investors from speculation to an extent, and also from unethical promoters, which is to say, it's very similar to the US market in the sense that you have to obviously have all your filings. You have to get an auditor. The auditor has to write a report. So you'll find the auditor's report in each of the annual reports. And because the taxation is now GST, it's a lot more frequent. It also it reduces the errors or the manipulation that managements could do. And so that's one thing. In addition, like even if you are looking to start a hedge fund, we call hedge funds in India portfolio management services. You yourself have to have a net worth close to, I think, almost $1 million in Indian rupees. That's around 7 crore rupees. I think it's very close to that number. So if you're looking to start a hedge fund here in India, you need to have X number of years of experience. I think it's 5. And then you also need to have your net worth in the fund should be around 5 crores, which is almost $1 million. And without that, you can't be in business. So the reason why they put those restrictions in place is that they only want to make sure the serious people who are dedicated and who have ethics necessary enter the market. And in addition, you need to hire 2 people just to, you need to have a chief compliance officer. You need to have one other person with other 5 years of experience. And after you have all of that, you have to pay a huge fee. Now, it might not sound like much in US dollars, but in Indian rupee, that's a big fee. So anybody who's either not made money himself in the markets for a long period of time or doesn't have the required experience, both, just cannot start a fund. So when we think about it from that perspective, SEBI is a lot stricter than the SEC, a lot more restrictive than the SEC in terms of who gets to make these investment decisions for you. And so I think 20 years ago, maybe it wasn't, where you would have hoped it to be, but in 2020 or 21, it really is a very well-run organization, and they just find the richest businessman in India, 1 crore rupees, fine, which, it's a testament to how far they've come in terms of really applying strict regulations for all market participants. So quality of accounting and just in general, the regulations they've set forth for, if you want to start your investment week or any financial organization, those are pretty high. So I think if people familiarize themselves with, these regulations, they'll be a lot more confident about prospects in India.
That makes a lot of sense. You mentioned early in your answer that there's a different taxation system there, and the companies pay taxes in a different way. Can you elaborate a little bit so people can understand what the implications of investing in India are?
Sure. I mean, so the taxation is GST, and it's not very different in the sense that, the taxation works pretty much the same way as it works here in the US. It's just the frequency is a lot higher. So I think depending on type of business, you could be getting taxed quarterly. And so you need to have your reports ready quarterly. Now, for, if you're preparing an annual report, it doesn't have to be audited. So if you're preparing a quarterly report, it doesn't have to be audited, much like here in the US. But because you're getting taxed that frequently, the manipulation with earnings, manipulation with extending depreciation schedules, or the way you recognize revenue, that gets limited quite a lot, quarter to quarter. Where for a year long, then you can do things with LIFO and FIFO and try and get a little bit more earnings than you probably did actually make. So it's not a huge difference. It's just the frequency is different, and that enforces a more disciplined, more ethical accounting approach.
Yeah, that makes a lot of sense. I remember my first buy-side job. We covered a lot of financial institutions, and because they could control their reserves, it was amazing how often these companies beat Wall Street sell-side expectations by a penny every single quarter. And it became interesting how predictable their businesses were.
Yep, and that is financial. I mean, it's legal, but it is certainly the playing to the street, and obviously you want to keep that stock price going up.
Yeah, I agree with you. It's legal and a very particular version of fraud.
Yeah.
Yeah, I'm with you on that. So given the different tax schemes, the different investment opportunities, what are the implications for, because most of our audience here are family offices and institutions, other hedge fund investors. what are the implications for that group of people of investing in India?
Well, I think from a family officer's perspective, you do want somebody who's at least somewhat familiar with these regulations. Now, I don't think it's as important to have boots on the ground as it used to be 20 years ago. But if you're investing in equities in India, it's good to have at least somebody who understands, not from a regulation standpoint. I don't think you'll have any problems dealing with SEBI, getting your money transferred there and then getting it transferred back and all that. That I think is pretty well. There's a lot of back-end infrastructure that allows you to do that. So the mechanics are not very difficult. I think as an investor, you have to be aware of certain nuances that exist in that economy. So certain sectors like construction or financial services, you have to be extra careful there. Whereas that's not a problem with tech, because the tech businesses are really a clone of the businesses that exist in the US. And there's not much you can do with those businesses typically. But in construction, especially in the unorganized sector of the economy, there was some problems. But as soon as you move into listed equities, where you have to have the financials and everything, your risk is way much comparable to what you would have in the US. But if you're looking at India as a whole, from if you want to invest in real estate or other sectors, maybe even venture capital, then I think you'll have to do your research, especially in real estate, because the market is still not very organized. Finding financials for real estate is a bit of a problem, and it's not all digitalized. So you just have this inefficiency in the real estate market in India, and whether some comes from fraud, I should say, that you have to be aware of. But from an equity standpoint in the public markets, I don't think you'll have I don't think you're going to have any bad experiences there, apart from obviously your own quality of investment.
Okay, makes sense. What about COVID-19? Obviously, India seemed to get hit late, but the last few months has certainly been rough for the country. That said, they have seemed to have avoided the disastrous shutdowns that we've had in a lot of Western countries. What are your thoughts about what happens next there, how they're navigating it? Are they doing it well, poorly? How long do you think this continues to be a problem there?
Well, I think India wasn't really prepared, in the sense that they didn't anticipate this huge second wave. That was really the problem. I think it dealt okay with the first wave, India. But second wave, we weren't prepared for that. The infrastructure was obviously, and I think it's not just an infrastructure problem. I think we also had an educational problem. People weren't following the guidelines properly with masks and everything. And so I think there was a communication problem, and they were lifting lockdowns when they shouldn't have been lifting lockdowns, and that caused a bit of a problem. So I think it was a mistake rather than something that just you couldn't help do anything about it. It was a mistake. So that was the unfortunate part. And then we exported a lot of vaccines that we should have kept for ourselves, which, of course, in hindsight is easy to say. When other countries were suffering, India exported a lot of vaccines, but they didn't anticipate the second wave, which I think you can think about how that makes sense, but wasn't the right move. And a country like India was always going to get hit badly in a pandemic situation with the population density that's just through the roof.
Right.
It was expected. So all that being said, I think we're on the road to recovery, provided there's no third wave. So I don't think with the vaccination efforts that we see in India that we should have a huge problem moving forward. Yes, there's a big part of the population that's still not vaccinated, but big part of the population, at least technically, has gone through COVID. So you have natural immunity. And so I'm not really aware of the exact science. If you had COVID, can you get it again or not? But I think based on what I've seen, the numbers have come down drastically over the last month or so. And we should be, unless there's some unexpected surprise, on the road to recovery. And it should be much similar to the US. I think we're about 4 to 5 months behind the US in terms of, how we should think about opening up. So I don't think long-term that's going to be a problem, obviously, year 2, 3, 4 years from now. I don't think, people will forget COVID and it's going to be maybe, they'll be occupied with something else. So I don't think it's a fundamental problem of any kind. But I would say another 6 months we're going to be in good shape, I think, after that.
One of the things that we've read on this is that one thing that will help India is the population there is relatively young without a very high incidence of obesity. And so those two factors hopefully will make the suffering there a little bit less than it's been in some other countries that have some of those comorbidity issues. We are running short on time, but before I let you go, I'd love to ask you, do you have a favorite idea in India that you'd like to talk about or that you're comfortable discussing?
I really like HDFC AMC. It's a mutual fund in India, and it functions in an oligopoly. Got 4 or 5 big mutual fund companies, and it's the best one out there. And mutual fund industry is really, if you think about what percentage of the population is invested in the US, so the Indian market, it's 90% compared to something like the US, where 50% of the population is invested. In India, and this is before this stock market boom, only I think around 4 to 6% of the population was invested in the market. That's a tiny number. And that coupled with the fact that discretionary incomes in India are going to explode over the next decade, expected to grow 10 times in the next 10 years. That means people will have money above their necessity. And so that money either goes into savings or the equity markets. So from a structural standpoint, the asset management industry in India is primed for at least 15, 20 years of great growth ahead of it. And so it's just a matter of finding the best player. And I think HDFC AMC is the best mutual fund in India. Looking at the track record, the performance, the governance, they've been around a long time, and they've got exceptional operational ability. And HDFC Bank, is probably one of the best banks, not just in India, but worldwide in terms of operations. So that coupled with, it's got huge economies of scale going forward. And it's an oligopoly, which huge barriers to entry. And I think it's not going to be similar to the US because of the barriers to entry. Like here in the US, you've got hundreds of mutual funds and many more actually. That's probably not going to happen in India, given the regulations and the huge economies of scale that these players have already. And in addition, they've got a robust banking system. So they've got all these branches all over India. That's how they acquire their customers, more or less, through their branches. And so they've got this big network working for them, huge economies of scale, and then like a vast market, like should be growing for at least the next 20 years ahead of them. So I think, in my view, that's the best investment opportunity that I found in India. And it's trading, I would say, slightly over fair value, around 15%. But if you're looking for a long-term compounder.
But we got your point that the mutual fund company you're talking about, maybe 15% overvalued, but if you're talking about compounding over the next decade, you could do extremely well.
Yeah, I think so.
That makes a lot of sense. On our end, we'd rather pay up for a great company with years of growth than do what's called cigar butt investing, where you're buying a crappy company for a very cheap price.
Yep. And also you have to keep finding one cigar butt after the other. So
right.
I think, just have a more peaceful time investing in these high quality companies.
Right. Yes. There are no additional points given for degree of difficulty.
Yeah.
I'm with you on that. Okay. Well, due to the technical difficulties on our end, we've gone over on time. But everyone, we want to thank Siddharth Singhai, the Chief Investment Officer of IronHold Capital, for being with us. First of all, congratulations on a fantastic launch. Thanks for being with us and talking to us about India today. And thanks also for all the great educational programs you guys do. Like I said, we've participated in some of them, and just think you guys in general doing fantastic work. For anyone who is listening to this, who is interested in what IronHold Capital is doing, feel free to reach out to me and we will put you in touch with their team right away. Siddharth, thank you so much.
Well, absolute pleasure to be here. Thank you for inviting me.
All right. And thanks for being on today's call.